So it is 7:09 in my watch, and I think in next 5 minutes and we are done. So now remember friends, we discussed that the value of money changes with the passage of time. As the time passes, the value of money diminishes. So if we have to make future cash flow comparable in terms of today's cash outflow, what we need to do, we need to discount the future cash flows. For discounting the future cash flow, we use the rate which is our expected rate of return. And as I said earlier, this expected rate of return of a business is expressed in multiple ways in the finance world. It is referred as cost of capital, it is referred as minimum rate of return, expected rate of return, required rate of return, it is referred as hurdle rate, reference rate, benchmark rate. So all those are the terms which are used for the purpose of the same thing, which is nothing but required rate of return or expected rate of return. So that one has to calculate, and I'm sure I took a very detailed example earlier, saying the 7% plus 5% plus 4%. So on that basis, we arrive at the a rate which is also known as discount factor or discounting rate. So now, how do you determine the discount factor? So our base discount rate is 10%. So you divide 1 by 1.1. So this is the discount factor for year 1. Now again divide this by 1.1, and this is your discount rate factor for year 2. And now what you do, you simply drag it. So this is how you can see that this discount factor is reducing. So what does it mean? It means a reduction in this discount factor is an indication that it is equalizing the future cash flows in terms of today's value. So now my free cash flow for year 1 is 180, but I need to convert this in terms of present value. So how do I convert this in terms of present value? I will convert this in terms of present value by taking the actual free cash flow, multiplying with the discount factor, and this becomes my present value of future cash flow for year 1. And like that, I will do it for all the 5 years, and you can see that this is, so it means what? It means the 468 crore of cash flow which I am getting in my hand in the 5th year, in terms of present value, it is 291. It is 291, right? So I'm sure you will remember what is the present value. The present value is nothing. What is the value of a business? The value of a business is nothing but present value of future cash flows during the explicit period plus present value of free cash flow during the terminal period. So what we have got, this is the present value of future cash flows during the explicit forecast period. Now I need to calculate free cash flow for the terminal period. So how do I calculate? And now please pay attention. How do I calculate the free cash flow for terminal period? So I will take the free cash flow of the last year. I will take the cash flow of the last year. How much it is? 468. It has been given to us the terminal growth rate is 3%. So I will multiply this 468 with 1.03. I will put this into parenthesis, or maybe I can keep them as it is, and divided it by my base discount rate, and from the base discount rate I will minus my terminal growth rate, which is 3. This I will put into parenthesis. this I will put into parenthesis. I hope it works.
Please explain again, sir.
No worries. I will. Right. So I will do it here for you. So now what I have to do, we all understand very clearly what is value of a business. Value of a business is nothing but the cash that it generates. Very good. But we also understand that the value of the money changes with the passage of time. What does it mean? It means I cannot take the future cash flow on the face value. I will need to convert the future cash flow in terms of present value. I have done it for the explicit forecast period, the 5 years. Now I need to do it for the terminal period. So I need to find out what is the present value of the free cash flow during the terminal period. Now to find that out, firstly I need to find out how much is my free cash flow during the terminal period. So for determination of free cash flow during the terminal period, there is a formula. And what that formula is, and I'm explaining to you here. So first put the equal sign. Take the cash flow of the last year of the explicit forecast period. I'm sure you will remember we discussed in our first part, and I told you terminal period starts where the explicit forecast period ends. Right? Terminal period starts where the explicit forecast period ends. So that means what? That means if I have to know the starting cash flow, what is the starting cash flow for the terminal period? The starting cash flow for the terminal period is this 468 that you see on the screen into the growth rate of the terminal period. So what is the growth rate of the terminal period? It is given in the case already that you know it is 3%. So that means what is the starting cash flow at the beginning of the terminal period? It is 468 into 1.03. 1.03. Now I need to capitalize it. Meaning what? Meaning now my discount rate is 10%. So I put it here 10% because this is I'm capitalizing. So when I say discount rate, that means this is my expected rate of return. So it's like this. If I'm earning a profit of 10 rupees in a year, my rate of return, expected rate of return is 10%. So what is the value? What is the value of this business? So let me explain to you again here. I can leave it for the timing. So that means remember 10 rupees is the profit that I am earning and my expected rate of return is 10%. What is the value of this business? The value of this business is 100 rupees. The value of this business is 100 rupees. Why 100 rupees? Because what is the profit that I am earning? 10 rupees. So let me just finish this, sir, and then I'll come to you. So this is divided by this. So this is 10%. So now what I have to do, just be with me. Firstly, I need to find out the cash flow for the terminal period. What do? Take the cash flow of the last year of the explicit forecast period, multiply it with 1.03, which is the growth rate during the terminal period. Now capitalize it. Capitalize it with my expected rate of return minus 0.03. So this is the growth that I am getting in any case. So when I do this, I get this figure of 46892. So this is my cash flow for the terminal period. Now, sir, that means, okay, before I go further, please go ahead, ask your question.